Placing a company into Members Voluntary Liquidation is extremely quick and easy to do, particularly if it is an owned and managed business, which most small to medium-sized businesses are. Officially, the required procedure is to call a meeting of directors in order to agree to call a meeting of shareholders 14 days later to place the company into liquidation and appoint a liquidator. However, usually the directors and shareholders meetings can be held simultaneously without the need for notice to be given, provided all parties agree. In these circumstances, P&Ls can prepare all of the necessary documentation and email those documents to all of the directors and shareholders for their signature. Once signed, the company will be placed into liquidation the same day. The liquidator will then become responsible for the company and will take steps to realise the company's assets. In most members' voluntary liquidations, the only creditor will be the revenue in respect of any final VAT, PAYE and corporation tax. The liquidator will typically instruct the company's accountants to prepare the final returns and pay the amounts due. The liquidator will then need to obtain tax clearance from the revenue to confirm that the company's tax affairs are complete. Once tax clearance has been received, the residual assets or cash reserves of the company can then be distributed to the shareholders. It is often possible to provide an immediate distribution to the shareholders of some, if not all, of the anticipated reserves. However, this will be case dependent and the directors and shareholders will need to discuss their requirements with the liquidator prior to appointment to see if an immediate distribution is possible. Once the final distribution has been made, the liquidator will prepare a final report and call a meeting of shareholders to approve that report and obtain his release. That report will then be filed at Companies House, who will then take the necessary steps to dissolve the company.